All right, let's dive right in. Welcome to today's executive briefing. We're putting on our senior equity research analyst hats to conduct a complete deep dive valuation of a really fascinating player in the industrials and materials space, Granite Construction, ticker symbol GVA. We've pulled all the latest filings, crunched the quarterly metrics, and we are going to run this through our financial models. Everything from relative multiples to a full discounted cash flow model, with some residual income and dividend discount stress testing thrown in for good measure. Basically, we want to figure out, is the market actually pricing this asset correctly? Let's find out.
Here is our roadmap for the briefing. 1. GVA stock, an overview. 2. Unpacking GVA valuation multiples. 3. Tracking growth and returns. 4. Financial health and margins. And finally, 5. The fair value verdict.
Starting off with Section 1, GVA stock, an overview, assessing the market position and recent momentum.
First things first, we need to understand the sheer scale of the business we're evaluating today. Granite Construction boasts a rock-solid market cap of just over $6 billion. And with the recent closing price of $139.42, this puts GVA squarely in the mid-cap space. You know, it's that perfect sweet spot for equity researchers, large enough to generate highly predictable cash flows, but still small enough to offer some really meaningful upside growth.
And man, just look at the sheer momentum behind this name lately. The bullish sentiment is practically off the charts. Year to date, we're up a healthy 21%. Trailing 12 months, a massive 76.51%. But step back and look at that 3-year period. GVA has delivered a staggering 272.91% return. Of course, any seasoned analyst sees a chart like that and immediately has to ask, wait, has the stock price completely outrun the underlying fundamentals?
Moving right along to Section 2. Unpacking GVA valuation multiples, contextualizing price against performance.
Before we get into the peer comparisons, let's briefly touch on a metric that's absolutely central to our thesis today, the PEG ratio. For those building out their own models, you know the price-to-earnings to growth ratio is the ultimate equalizer for high-momentum stocks. A traditional PE ratio can look terrifyingly high if a company is growing rapidly. But by adjusting for that earnings growth, a PEG ratio below 1.0 is a massive signal that a stock might actually be fundamentally undervalued, completely regardless of its recent price run-up.
Now, this is where the narrative gets super interesting. On the surface, a trailing PE ratio of 40.06 seems incredibly steep for a heavy construction firm, right? But context is everything. That PE is actually 12% lower than its own 3-year historical average of 45.58. The EV to EBITDA multiple is sitting at a very reasonable 14.29. But the true star of the show here is that PEG ratio at the bottom. Despite the stock nearly tripling in 3 years, the PEG is sitting at just 0.78. That firmly flags GVA as a value play. It tells us their earnings growth is actually outpacing the stock's explosive price appreciation.
So, into Section 3 we go. Tracking growth and returns. The engines driving the valuation.
So what exactly is powering that low PEG ratio? Well, the answer is this absolutely explosive 3-year growth. We're looking at the compound annual growth rate of GVA's earnings per share. 5-year EPS grew at a very solid 40.82%. But over the last 3 years, they hit a massive 133.64% annualized growth rate. That is literally game-changing. It's pulled their trailing 12-month net income up to an impressive $193 million, backed by a top-line revenue of $4.4 billion.
But hey, growth is really only half the equation, right? As analysts, we want to know how efficiently management is deploying all that capital, and they are delivering. They boosted their return on invested capital from a historical 3-year baseline of 4.98% all the way up to 8.12%. That's a 63% relative improvement. So they aren't just aggressively growing their earnings, they are squeezing much higher quality returns out of the capital they're putting into new projects.
Which brings us to Section 4, Financial Health and Margins, checking the balance sheet and profitability. Looking at the profitability funnel, we have to acknowledge the realities of the heavy construction sector. It's capital intensive. GVA captures about 15.46% in gross profit. Then, after operating expenses, depreciation, and a 23.71% tax rate, the final bottom line net profit margin sits at 3.76%. Now, single digits might sound razor thin to a tech investor, but for this specific industry, it's incredibly solid. Plus, that 3.76% is well above their 3-year average of 2.47%. They are literally squeezing more profit out of every single dollar than they have in years.
Okay, let's flip the coin and look at the risks, because there is a slight bear case building here around liquidity. Both the current and quick ratios have dropped by roughly 22% compared to their historical 3-year averages. Now, to be clear, a current ratio of 1.22 means they still have plenty of current assets to cover immediate liabilities. But as equity researchers, a downward trend of 22% is definitely a variable we're plugging into our risk assessments.
And alongside that tightening liquidity, we absolutely have to flag that leverage is creeping up. The current debt-to-equity ratio sits at 1.14. That's a 67% jump from the 3-year average of just 0.68. Now let's be real, you don't get a 133% annualized EPS growth without using some debt to fuel the fire. That's standard corporate finance. But a rising debt load paired with shrinking liquidity? That is 100% a watch item we'll be scrutinizing in the upcoming 10Q filings. Finally, Section 5, the fair value verdict. Discounted cash flow and final target price.
All right, the moment of truth. To find the real intrinsic value here, we're relying heavily on our discounted cash flow model. This is the absolute gold standard for cutting through market noise. We forecast a free cash flow to the firm, apply a terminal value using a perpetual growth rate, and discount it all back using our calculated weighted average cost of capital. We did run a residual income model and a dividend discount model just to stress test the thesis, but the DCF is our primary compass today, focusing purely on the core cash this business generates.
So here's the ultimate question for your portfolio strategy. Taking into account that explosive 133% earnings growth, the vastly improved ROIC, but also baking in the higher debt load, is Granite Construction's current market price of around $139 actually cheap? Let's let the math decide. The math does not lie. Based on the projected free cash flows, our DCF model points to an intrinsic fair value price of $263.04 per share. Compare that to the current market price of $139.42. That valuation gap is simply profound. It indicates massive upside potential from current trading levels, assuming management continues to execute on their cash flow projections.
Because of that incredibly wide gap, this stock is currently offering us a massive 47% margin of safety. In the value investing world, a cushion this wide is exactly what you look for to protect against unforeseen macro downturns or minor execution hiccups. And honestly, even when we ran our sensitivity analysis, bumping the WACC up and down by a whole percent, tweaking the terminal growth rates, that 47% margin holds up as a highly compelling buffer.
Let's pull it all together for the executive summary. On the bull side, we have explosive historical earnings growth with that 133% EPS CAGR. Despite a 270% price run-up over 3 years, the PE multiples are somehow still trading below historical averages, and capital efficiency is on the rise. On the bear side, our main watch item is definitely that rising debt load and shrinking liquidity. But the bottom line? An exceptional 47% margin of safety makes this a deeply compelling valuation.
I want to leave you with a provocative thought as you go build out your own spreadsheets. We've seen the raw data today. We've seen the earnings momentum, the relative multiples, and the definitive DCF output. With a 47% margin of safety sitting right there in plain sight, has Wall Street just completely fallen asleep at the wheel and fundamentally mispriced Granite Construction's future cash flows? It's a fascinating question, and one I absolutely encourage you to dig into further. Thanks so much for joining me for this explainer, and happy analyzing.